Today, we will talk about distribution in finance, definition, types, and examples. The word distribution in finance refers to the payment of assets from a fund, account, or individual security to an investor or beneficiary. For example, when the account holder of a retirement account reaches a certain age, they are required to receive a distribution from the account. This can be in the form of stock, cash, or other payouts from a company or mutual fund, and is usually paid directly to the beneficiary either electronically or by check. In finance, distributions can mean many things, but they are generally regarded as cash that goes straight into your pocket. For example, with mutual funds, distributions represent the allocation of capital gains and dividend or interest income to investors periodically during a calendar year. When these dividends and distributions are disbursed, the fund's share price declines by the total of the per-share distribution to the fund's shareholders because the distribution is withdrawn from the fund's assets, which decreases the net asset value. Mutual fund distributions consist of net capital gains made from the profitable sale of portfolio assets, along with dividend income and interest earned by those assets. For example, if a stock is bought for $75 and later sold for $150, the capital gains are $75 minus the fund's operating expenses. The exact amount of the distribution is tallied after the subtraction of these operating expenses. Once dividends and distributions are disbursed, the fund's share price declines by the total of the per-share distribution to the fund's shareholders, as the distribution is withdrawn from the fund's assets, which decreases the net asset value. Distributions for stocks or bonds are payments of interest, principal, or dividend by the issuer of the security to investors. For example, when a corporation earns a profit, it may pay a portion of the profit to shareholders in the form of a dividend, or offer a dividend reinvestment plan where investors can use the amount to buy additional shares of the stock or fund. Investment trust distributions are similar to stock dividends but typically offer higher yields. They generally function as monthly or quarterly distributions to investors, and the distributions received lower a trust's taxable income. Distributions from traditional IRA and Roth IRA accounts, and other retirement accounts have specific rules and restrictions. For example, distributions from a traditional individual retirement account can happen at any time after the creation of the account, while distributions from Roth IRAs generally require the funds to remain in the account until age 59.5 before distribution. For example, the Fidelity 500 Index Fund distributes dividend payments quarterly in April, July, October, and December to investors. These distributions can be automatically reinvested by Fidelity unless the customer specifies otherwise. A capital gains distribution is a cash payment made by a mutual fund or exchange-traded fund to fund owners. If a mutual fund holds a capital asset for more than 1 year and then sells it, the fund usually passes on the profit to you as a capital gains distribution. A deed of distribution is a method of legally transferring property when the rightful receiver can't be determined from the descendant's will. A lump sum distribution is a cash disbursement that is paid out all at once. This can come from retirement plans, earned commissions, or certain debt instruments. Here are 5 key takeaways. 1. A distribution generally refers to the disbursement of assets from a fund, account, or individual security to an investor. 2. Mutual fund distributions consist of net capital gains made from the profitable sale of portfolio assets, along with dividend income and interest earned by those assets. 3. With securities, like stocks or bonds, a distribution is a payment of interest, principal, or dividend by the issuer of the security to investors. 4. Tax-advantaged retirement accounts carry required minimum distributions, mandatory withdrawals after the account holder reaches a certain age. 5. A lump sum distribution is a cash disbursement that is paid out all at once, as opposed to being paid out in steady installments. Hope this would help. Thanks for watching.